Good afternoon, everyone. I am Michael Corselli, the chairman and founder of FLYA. And I'm excited to introduce a good friend of mine, Jeremy Todd, who's the head of capital markets at Prime Meridian Capital Management. Today, Jeremy's going to be speaking to you about investment opportunities in the alternative credit space, a very popular space right now. In particular, he's going to discuss the current outlook and considerations prior to investing in this particular asset class, some of the methods to look at this asset class, and he's also going to provide an overview of an early fund manager in this space, Prime Meridian Capital Management. They are one of the leading dedicated alternative credit managers in the industry. Jeremy's been with Prime Meridian coming up on 3 years now. Before he went to Prime Meridian, he spent almost 20 years working on Wall Street for major banks such as Bank of America, Bear Stearns, Bank of New York Mellon, and Barclays Capital. Jeremy started personally investing in the alternative credit asset class about 10 years ago across numerous investments. He then transitioned into the alternative credit industry from Wall Street, where he has written multiple papers on the best practices investing in the alternative credit space. At Prime Meridian, Jeremy's part of the management team, primarily responsible for marketing and investor relations. Once again, I want to thank everyone for being on the meeting today. At this time, I will turn the presentation over to Jeremy. Jeremy, it's all yours.
Thank you for the kind introduction, Michael, and thank you, FLYA, for the opportunity to present today. Good morning, and I should probably say good afternoon and evening to everyone as well, as I know we have people participating today in multiple time zones around the world. As Michael said, my name is Jeremy Todd, and I have the capital markets business at Prime Meridian Capital Management. Prime Meridian is an approximately $380 million alternative credit manager offering 4 main funds based in the San Francisco Bay Area. The topic of my presentation is the current outlook investing in alternative credit, an overview of our firm, Prime Meridian Capital Management. And we sincerely appreciate everyone taking the time today to join and participate in this presentation. I will cover 5 main topics, which are the current outlook investing in alternative credit, the key considerations before investing, and the various methods to invest in the alternative credit asset class. I will then provide an overview of Prime Meridian Capital Management and also provide a snapshot into each of our 4 primary funds that we manage. I want this presentation to please be as interactive as possible, and we'll try to answer some questions as they come up throughout it, in addition to answering questions at the end. So please feel free to type in any questions at any time, and Michael or my colleague Serena Pham will help ask them as we go along. To begin, I want to provide an outlook on the 5 main alternative credit verticals that Prime Meridian invest in. First of all, on the consumer loan side, the performance has been relatively strong this year, even in this bad economic environment, mainly as a result of the stimulus packages. The stimulus checks, along with additional employment insurance benefits and other relief benefits, coupled with households reducing certain spending, has resulted in many consumers continuing to make payments on their consumer loans. Now, as the economy continues to slowly but surely recover, there are far less consumers requesting temporary relief on their loans than earlier this year. For example, at one of the leading consumer lending platforms we buy loans from, there were 4,000 to 5,000 requests a week for some kind of financial relief on their consumer loans at the beginning of the crisis, but in recent weeks, this number has dropped over 95% to just a couple hundred requests a week. There is certainly the risk, though, that if unemployment sharply rises again without additional relief packages passing, that the performance of consumer loans could worsen. Secondly, the real estate bridge loans have performed relatively well so far this year, too. This could be greatly attributed to the Fed materially reducing interest rates to record low levels, which has resulted in very high demand for residential real estate over the last few months. Keep in mind that residential bridge loans are for owner-occupied homes. These bridge loans are obtained by real estate investors to buy a property, renovate it, and then either sell it within a few months or refinance the loan, usually within a year, if they decide to rent out the property. As a result, their forbearance programs for homeowners who live in their homes don't apply to these residential bridge loans. That being said, many lending platforms we purchase loans from did offer some form of temporary relief to these investors if needed to help them in the short run. On the commercial loan side, about a third of investors did request relief through forbearance programs, which typically offered a reprieve of around 3 to 4 months of monthly interest payments. So we are now, until October though, the forbearance window for many of these requests have closed, and many of these borrowers are now paying both the current and past due interest owed as well. Another key point is that the overall funding of loans decreased in the second quarter, and the interest rate on these new loans in this period typically was higher than pre-COVID. However, now with the increased demand in both real estate and real estate bridge loans, these higher interest rates have basically returned to pre-COVID levels. The end result of all these points is that the overall performance of real estate bridge loans has been positive, and we continue to expect strong performance for the remainder of this year and into next year. Small business loans have had the most detrimental impact this year resulting from COVID. Many small businesses that acquire loans from fintech lending companies typically have around $1 million or less in revenue and maybe around 10 employees or so. Many of these businesses have been materially affected by the shutdowns and have had trouble making their loan payments. Even though many of these small businesses receive PPP loans from the government, they still have had a hard time paying back their existing small business loans. Therefore, small business delinquencies and defaults have increased significantly, even though the economy is slowly improving. Going forward, we still see a challenging environment for small business loans through the end of this year and probably at least through the first half of next year. And as a result, it is very important to be cautious and quite selective in potentially buying any new small business loans for the foreseeable future. The life settlements industry has performed quite well in this economic environment. There has been even stronger demand for this asset class as investors seek to add more alternative asset classes besides traditional ones. The trade-off of life settlements performing so well is that the increased demand for them has resulted in the yield of new policies to be lower than it was 6 months ago. Additionally, as a result of these challenging economic times, there are significantly more people in their 40s and 50s and 60s that are now selling their policies to raise cash than there were just 6 months ago. The effect from all these points is that it is very important for investors to be quite selective in choosing the right policies to achieve strong risk-adjusted returns in this asset class. With proper portfolio management, though, and owning the right combination of policies, we believe that life settlements will continue to perform very well for the foreseeable future. Similarly to life settlements, the litigation finance asset class has performed well during this economic environment. The main outcome from the crisis for litigation finance is that the U.S. court systems are taking much longer to hear cases, which obviously affects the amount of time for case resolutions. Depending upon how one invests in the litigation finance asset class, this may or may not have an impact on performance. For investors that buy individual cases, then waiting longer for a case to get resolved impacts the overall internal rate of return on the investment. For investors that structure the litigation finance as a loan, then the impact is minimal because the investment continues to accrue interest as well during this extended waiting time for resolution. This has also enabled investors to be even more selective with cases to fund as a result of the market conditions too, which is positive for this asset class. We expect the remainder of this year and next year to continue to be strong for litigation finance. There are always lawsuits in the U.S. regardless of economic conditions, and frankly, typically even more lawsuits are filed in challenging economic times. And as the court capacity increases next year, many more lawsuits will get resolved, which bodes well for litigation finance investments too. So to summarize, we believe that life settlements, litigation finance, real estate, and the consumer verticals will most likely continue to perform well over the next year. There is potentially some higher risk in the consumer vertical, though, if the current economic conditions deteriorate from here. The small business vertical will have the most challenging time over the next year as the economy continues to recover. Moving on, now that I have covered the current outlook for alternative credit, let's discuss the three main methods to invest in this asset class. For accredited investors, the first option is to invest in a hedge fund. There are open-ended hedge funds that typically allow for continuous subscriptions and redemptions, and there are closed-end funds that have a defined subscription period, raise a finite amount of assets, and invest the assets and pay out the proceeds typically over several years. The second option is for both accredited and non-accredited investors, and that is to invest through mutual funds. There are now 4 focused mutual funds, including one from Prime Meridian and a partner Alpha-Centric that we launched at the beginning of the year. Since the alternative credit assets are not as liquid investments as traditional asset classes, the mutual funds are typically structured as interval funds. Whereas most open-ended mutual funds offer daily subscriptions and redemptions, interval funds offer daily subscriptions but only quarterly redemptions with some other restrictions as well. And a limited number of lending platforms offer a retail platform too, which is the third option to invest. Most assets today, though, invested in alternative credit is done through hedge funds, but investing through mutual funds is becoming a lot more popular as well. There are several key factors to consider before investing in the alternative credit asset class. The first is determining whether the risk-return profile of the alternative credit asset class meets an investor's objectives. That is obviously for each investor to decide for him or herself based upon their own investment objectives. If the asset class does meet an investor's objectives, then they should review several criteria before investing. The first is determining whether the prospective manager has proven money management experience within the alternative credit asset class. Managing the different risk factors, credit analysis, portfolio attribution, counterparty risk, and operational risk requires extensive experience, especially in this asset class. This is not easy to do and is the reason why over half the dedicated managers in this asset class have closed down in the last few years. An investor also needs to determine what type of investment structure to use when making an investment in the asset class, which I just described a couple minutes ago, are usually through either hedge funds or mutual funds. Additionally, an investor obviously needs to understand the fees charged by the manager. Typically, there are 3 fees charged, which are management fees, performance fees, and operating expenses paid by the fund's assets. Another important consideration is the liquidity of the fund. Does the manager have a lockup? And if so, what is the notice period for making a redemption? Is the redemption period monthly or quarterly? Just to name a few of the key liquidity terms to be understood. An investor needs to understand what is the valuation methodology for the fund too. This means, is the fund valued daily or monthly? Is it done by a reputable third-party firm who objectively values the portfolio using approved regulatory valuation methodologies? Or does the manager perform their own internal valuation, which allows for potential problems that an investor needs to thoroughly review? And lastly, what is the operational infrastructure of the firm? Does the firm use top-tier third-party service providers for audits, legal, administration, and valuation? Also, does the firm use a third-party custodian, even though these are level 3 assets and don't typically require it? Does the firm have a robust technological infrastructure for loan analysis, risk management, and portfolio reporting as well? These are the very important considerations to understand before making an investment in alternative credit. Many investors could have avoided investing in several of the alternative credit firms that have closed down in the last few years by performing better due diligence on these items beforehand. And as Michael mentioned in the opening, I have written a white paper on the best practices when investing in this asset class and would be happy to share it with anyone who is interested. Please feel free to send me an email if you would like a copy, and I have my email at the end of this presentation. Now that I have covered the first 3 topics, let's move on to the overview of Prime Meridian Capital Management. The firm was founded in 2012 by Don Davis, who was one of the first experienced portfolio managers that recognized there would be a need for institutional quality investment funds within the marketplace lending and alternative credit asset class. Prior to starting Prime Meridian, Don was the top-ranked futures trader for risk-adjusted returns over both a 5-year and 7-year period. And after personally investing in the marketplace lending asset class starting about 10 years ago, Don came to the conclusion that starting a firm offering multiple verticals and alternative credit to meet different firms and individuals' investment objectives should be appealing, as these strategies offer short duration, high yielding, lower volatility, and lower correlation as compared to other traditional asset classes. There are several differentiating factors about Prime Meridian that we believe makes us unique and well-positioned to continue to offer world-class investment products to investors. The first is that we are one of the most experienced managers in this asset class, and we're one of the first institutional managers in this space when we started in 2012. We have one of the longest track records, offering consistently strong performance, and have sizable assets under management compared to other dedicated managers in this asset class. Our collective investment experience across the team is over 90 years total. We're the only dedicated manager in this asset class that we're aware of that offers multiple funds across different verticals to investors, each of which has its own proprietary credit model. Across our 4 main funds, we currently invest in 14 different quality originators and have over 20,000 loans and investments in total. All of our funds are valued by an independent third-party firm using conservative discounted cash flow valuation methodologies. Since the assets we invest in are level 3 assets, the fund's returns are typically less volatile than other traditional asset classes. Additionally, these assets are typically less correlated as well to traditional asset classes, especially life settlements and litigation finance, which respectively are uncorrelated and have very little correlation. We also ensure that the loans we invest in are done through bankruptcy remote vehicles, which means the assets are held separately from the balance sheets of the origination platforms. I will discuss in more detail in a few minutes our risk management expertise, but we are very conservative investors and are quite focused on mitigating portfolio, credit, and counterparty risk. Lastly, we take our fiduciary responsibility very seriously and have a quite robust institutional quality infrastructure offering strong safety and soundness of an investor's assets when they invest with us. We use the leading third-party service providers in every area possible. We use the top administrator in this asset class, an experienced third-party valuation firm, and a top accounting firm to audit our funds. In addition, even though our investments are mainly level 3 assets that don't technically require a third-party custodian, we use the leading third-party custodian to hold our assets anyway to provide our investors peace of mind when investing with us. We take very seriously providing both strong risk-adjusted returns while also providing an institutional quality operational infrastructure for our clients using best-in-class third-party service providers. Prime Meridian has been nominated and won several awards over the years. We have made the Inc. 500 list and the Inc. 5000 list multiple times. Prime Meridian was also number 6 in the fastest growing private companies 100 list from the San Francisco Business Times a couple of years ago, which is notable since the Bay Area is dwarfed by the technology industry. But the award that we are probably most proud of is the Lendit Top Fund Manager of the Year award. Lendit is the leading organization that every lending company, investment manager, and service provider in the alternative credit industry is a part of. The organization has a panel of senior executives from the top firms in the industry that vote on different types of awards within the alternative credit space. In the 9 years of the organization passing out awards, they have only passed out 1 award ever for top fund manager in the industry, and Prime Meridian Capital Management won that award a couple of years ago. The next slide provides a timeline of key events in the history of Prime Meridian and a couple of events from our industry. Don Davis started his managed futures business called Novus Investments in 2004. In 2006, Prosper started, which was the first US-based marketplace lending platform. Lending Club was founded soon thereafter in 2007 and is now probably the most well-known marketplace lending firm in the US. In 2012, Prime Meridian Capital Management was founded, and the Prime Meridian Income Fund was launched. In 2016, the Prime Meridian Real Estate Lending Fund was launched. In June of 2018, the Special Opportunities Fund was started. And lastly, as I mentioned earlier, we launched our first public mutual fund called the Alpha-Centric Prime Meridian Income Fund in January of this year. As you can see, we historically have launched a new product offering to investors every couple of years. Before I provide an overview of each of the four funds, I want to first explain the risk management process that we have for every fund. The first step is we conduct an extensive counterparty risk assessment on each origination platform and counterparty we have. This includes comprehensive due diligence on the experience of the management teams and reviewing their operational processes. Additionally, we analyze the financial stability of the firm itself. This includes reviewing the revenues, cash flows, cash burn rates, and funding capacity, amongst other financials. If the firm passes the counterparty risk assessment test, then the second step we do is to conduct a thorough analysis of the origination platform's underwriting performance. This process includes acquiring a deep understanding of the platform's credit underwriting practices, and before we are willing to invest, we have as a requirement that we must be provided by the platform their entire historical loan tape. We then import this data into our own proprietary analytics program to standardize the data to properly compare it to the other origination platforms' loan performance within each vertical to determine which platforms do the best job underwriting quality loans. We then determine if the prospective origination platform's underwriting standards meet our requirements for investment. If the platform passes the second risk assessment step, then the third step is to build our own proprietary credit model for each platform that we purchase loans from. The models we create try to identify the loans that we believe will offer the best return versus the perceived risk of each loan. Also, we are consistently revising the models over time as a result of the continuous portfolio monitoring by analyzing the most recent loan performance data. The last step of the risk management process is the portfolio construction process. Just as importantly as choosing the best individual loans for the portfolios, it is just as important to have the right number of total loans in each one and build the right portfolio attribution of loans within the overall portfolio. As an example, within our real estate fund, we have a very well-balanced, diversified pool of commercial loans, single-family residential loans, and multifamily residential loans across 40+ states. We minimize risk by diversifying loan characteristics across geographies, borrower and property types, amongst other factors. And lastly, although we mainly purchase whole loans and sometimes fractional loans from origination platforms, we also selectively offer lines of credit to certain platforms. Lines of credit provide initial funding for an origination platform to fund a new loan, whereas purchasing loans is typically acquiring a newly underwritten loan from a platform that first uses their line of credit to fund that loan. And both investment types potentially offer good returns and help further diversify the overall fund's portfolio risk. And following these four steps, we are very confident in our meticulous risk management process, which has resulted both in the strong historical performance of our funds, but also especially the relatively strong performance of each fund this year in this challenging economic environment. This slide provides a snapshot of the four different funds that we offer investors. Our first fund, the Prime Meridian Income Fund, invests primarily in consumer loans, but also invests in real estate and potentially small business loans. The Prime Meridian Real Estate Lending Fund invests in first lien bridge loans across single-family and multifamily residential properties and also in commercial properties. The Prime Meridian Special Opportunities Fund invests in life settlement policies, litigation finance, and specialty credit opportunities. And lastly, the Alpha-Centric Prime Meridian Income Fund is a publicly traded mutual fund that invests in consumer, real estate, and small business loans. And although in each of these various funds, we offer investors exposure to different verticals within alternative credit, each of them are short duration and high yielding funds that offer lower volatility and lower correlation to other traditional asset classes. And it looks like we got one of our first questions. Maybe I'll let Serena, if you want to answer that or ask me that.
Yes. The question we received is, do most of your clients invest in just one fund or invest in multiple Prime Meridian funds?
Yeah, I don't have the exact percentages in front of me, but could say a good percentage of our clients do invest in multiple funds of ours. One of the reasons why we offer multiple funds is to provide our clients with as many options to invest in alternative credit that meet their investment objectives. There might be investors, for example, that already have enough real estate exposure when they review our funds, so they might only be interested in the other funds that we offer. However, many longstanding clients that already invest in the Prime Meridian Income Fund or the Real Estate Fund did not previously have any exposure to life settlements or litigation finance, so many existing clients invested additional assets into our soft fund. We are indifferent, frankly, as to which funds that clients decide to invest in, as we believe each of them offer compelling value based upon their own respective investment objectives. And I guess the last point I'll make is I will say that we're certainly open to providing assistance to investors to guide them on which funds make the most sense for them based upon their own investment objectives. Thank you for the first question. So moving on, I will next provide a more detailed overview of each of the individual funds. I will start with our first fund we launched in 2012, which is our Prime Meridian Income Fund. The fund currently invests in about 70% consumer loans and 30% real estate loans. The Prime Meridian Income Fund currently holds over 9,000 different loans across 6 different lending platforms. Over the past 8 years, its performance has averaged about 6.3% annualized and is up 3% year to date. It has had only one down month in its history, which was March of this year when it lost 1.5%. And if you remember, though, in March of this year, the equity index has lost double digits and was extremely volatile, being down around 25% at one point. The average remaining duration of the loans currently in the portfolio is only about 7 months, and most of the loans are made to prime borrowers with an average income of $44,000. The average loan size is relatively low at a little over $2,000. This fund has been our best performing fund over the past 6 months, mainly resulting, again, from consumers benefiting from the stimulus packages that I described earlier. The fund has a $500,000 minimum investment, a 75 basis point management fee, a 10% performance fee, and the monthly liquidity is available at a 45 days notice, always on a best efforts basis. And again, we expect continued strong performance in this fund over the foreseeable future, assuming the economy continues to rebound. The real estate lending fund was launched in February 2016, so it now has a 4.5-year track record. As I briefly highlighted earlier, the fund invests in all bridge loans across single-family and multifamily residential properties, and it also invests in commercial loans. The fund holds about 400 loans, and the percentage allocation across the 3 property types is currently about 40% commercial, 35% multifamily residential, and 25% single-family residential properties. The geographic location of the properties is very well diversified as well, with about 40% of the fund in the Northeast and 20% each in the West, Midwest, and Southeast. Again, all these loans are bridge loans. For those of you who may not be as familiar with bridge loans, these are loans that are typically used by borrowers to acquire investment properties from non-traditional bank financing sources. Many traditional banks can sometimes take months for an approval, where investors bidding on properties need a very quick approval process and faster loan process times and loan escrow closing times in order to successfully buy these properties. These borrowers prefer to use bridge financing from non-traditional bank sources and typically pay high interest rates that are materially higher than normal owner-occupied financing. These financing rates are usually between 8% to the low teens sometimes. Investors will then renovate the properties, and upon completion, they will either sell the properties, hoping to make a profit, or they will then rent out the properties. If they sell the property, this usually happens within the first several months. And on the other hand, if they rent out the property, they will then typically refinance the property with a traditional bank lender at this point at a lower interest rate than the initial higher bridge financing rate. The structure of these loans are usually interest-only monthly payments and then principal balloon payments at maturity. The typical term are 12-month loans, except that some of the commercial loans will have longer maturities. The current Macaulay duration of the portfolio, though, is only about 7 months, which is a positive for investors for the fund for liquidity purposes. All the loans are first lien, and we don't invest in second lien, mezzanine, or equity in this fund. Another important note is that in all the residential loans we purchase, the borrower provides personal guarantees. The average portfolio LTV is less than 65%, and the maximum LTV we will go on any one loan is 75%. So this means, by definition, the equity upon completion of the renovation on average is about 35%, which is extremely beneficial in case of possible loan defaults. The year-to-date return of the fund is about 4% through August, and the returns of the fund since inception has averaged just under 8% over its 4.5-year history. It is also noteworthy that the fund has never had a down month. Again, using March of this year as an example, the real estate fund still had a small positive month of around 18 basis points. We believe what makes this fund unique compared to other real estate funds in the market is, one, the fund does not use any leverage. Most other real estate funds have historically used leverage, which has been a challenge for them over down economic environments like this year. Secondly, our loan-to-value ratios compared to other real estate funds is much lower, again being less than 65% LTV. Many funds go as high as 80 to 90% LTV. And having a lower LTV means there's a lot of equity built into the portfolio that can better withstand challenges in the economy such as the one that we're in right now. Third of all, our allocation to construction loans is only about 10%, which many real estate funds have a much higher allocation to these types of loans. And lastly, again, we only purchase first liens where many real estate funds take on more risk, purchasing second lien, mezzanine, or even equity in the real estate funds. This conservative nature of being very well diversified across property type, geographic location, not using leverage, and investing in the less risky loans is frankly indicative of how we manage all of our funds. In good economic environments, this means that we will potentially sacrifice some performance on the upside, but in these challenging economic environments, our investors appreciate even more so our conservative approach, as it not only better protects their principal, but still offers relatively enhanced upside returns as well. Therefore, our goal is not to chase returns and try to be the top performing fund in any one year, but to be a top percentile risk-adjusted performing fund over an entire economic cycle, as we believe this produces better long-term results for investors. The Prime Meridian Special Opportunities Fund is a unique fund in that it is likely the only open-ended hedge fund that invests in a combination of life insurance policies, litigation finance, and specialty credit. For comparison, other funds that invest in life insurance policies, also known as life settlements, typically invest 100% of the funds in these policies. This also holds true for litigation finance funds. Furthermore, most of the life settlement funds and litigation finance funds are not open-ended structures that offer continuous subscriptions and redemptions, but rather closed-end structures where your investment is locked up usually for a minimum of 3 to 5 years. The benefits of combining these three asset classes into one fund are threefold. One is that investors can likely achieve around a 10% annualized return, and two, have low volatility and low correlation of these returns compared to traditional asset classes, while three, still having a much better liquidity terms than other available dedicated life settlements and litigation finance funds. The reason we could offer an open-ended fund structure that provides better liquidity is for two reasons. The first is that by investing about a third of the portfolio in specialty credit, these investments have a set monthly interest payment schedule, providing a high-yielding and consistent flow to the fund of cash proceeds. The second reason is that we structure our litigation finance investments as a loan structure, which provides more consistent cash flow to the fund than buying individual lawsuits on a one-by-one basis. Let me provide a more detailed overview of each of the investment types within the fund, and we'll start with life settlements. For those of you who may not be familiar with life settlements, I'll provide a brief explanation on how these investments work. To begin, the life insurance business is a trillion-dollar industry in the United States. Individuals typically purchase life insurance as a financial planning tool. People buy the life insurance policies from an insurance company that agrees to pay the policyholder beneficiaries a predetermined amount of money upon the policyholder's passing. In return, the policyholder agrees to pay monthly premiums to the insurance company every month until he or she passes. What happens more times than many people realize is that the policyholder's life circumstances change and they now need the cash to live off during their lifetime. For example, it could be that they encountered unexpected large medical expenses or other types of expenses that need to be paid. And as I mentioned earlier, this year is a good example of a time when more and more people in their 40s and 50s and 60s are cashing out their life insurance policies. Another scenario is an individual's financial planning situation has changed where it is now more advantageous for him or her to sell their policy during their lifetime. Many times, a life insurance policy is the remaining largest financial asset the person has of value, and as a result, the individual looks to sell and cash out the current value of their life insurance policy if needed. There is a large secondary market where people can sell their policies and receive the current market value of it. The buyer of the life insurance policy pays an agreed upon sales price to acquire it, but then has to continue to pay the monthly premiums of the policies directly to the insurance company until the original policyholder passes. At this point, the insurance company will pay out the death benefit value to the current policyholder. Prime Meridian purchases each policy in the Special Opportunities Fund individually from one of the largest firms involved in the life insurance marketplace. When we started the fund almost 2.5 years ago, we started purchasing policies one at a time and now have about 140 policies in the fund. The average purchase price of the policies we own is about $240,000, while the average death benefit is $750,000, which makes the average purchase price around 32% of the death benefit value. The average age of the original policyholder is about 75 years old, and the average remaining life expectancy is just over 4 years based upon the actuarial tables. We hold policies from 6 different medical underwriters, with an A rating being the lowest policy we hold. When you account for all this data of the specific policies we own, the end result is an expected double-digit return for our life settlement policies in the fund. It is certainly important to note the obvious when investing in life settlements, that inevitably some policies mature before expectations and others after expectations from what is predicted in the actuarial analysis. The last very important point to understand about life settlements is that they have historically been uncorrelated to traditional asset classes, and this is positive in that investors reduce overall portfolio risk when you hold uncorrelated assets, which is especially beneficial in these challenging economic environments like we're in now. And it looks like, Serena, we have another question?
Yes. The next question that we received is, how do you address the stigma of profiting from an investment from someone passing away?
Yeah, that's a good question. As I mentioned, many life insurance policyholders have unexpected life circumstances when they need money during their lifetime that they don't have elsewhere. and many of them have used up savings and possibly don't have equity in the house to tap into, and the last valuable asset they could possibly monetize is their life insurance policy. Thankfully, there is a secondary market for life insurance policies to provide these individuals with the option to sell this asset to raise cash. The key thing to note is no one is forcing anyone to do anything, but simply provides them a marketplace to sell if they choose to. But think about it another way. If someone wanted to sell but couldn't, and therefore not able to solve whatever financial hardship they're having, that would be very problematic for both that individual, but frankly also society as a whole, to need to step in and help him or her in that situation. So life settlements provides a valuable tool for individuals to raise cash while enabling investors to generate a valuable return as well. Thanks for that question. So moving on, litigation finance is investing in outstanding lawsuits filed by plaintiffs in the United States courts. For example, many lawsuits deal with accidents such as those involving cars and motorcycles, or deal with medical malpractice or labor laws. When a plaintiff files a lawsuit, many times they need access to funds to pay their bills before the lawsuit is resolved, as many lawsuits can likely take months or years before resolution. As a result, the plaintiff may decide to receive an upfront payment from an investor before the lawsuit is resolved. In exchange for this upfront payment, though, the plaintiff will agree to share a portion of any judgment or settlement payouts with the investor upon resolution of the lawsuit. These types of investments are called litigation finance. Just as the life insurance business is $1 trillion business in the U.S., the litigation finance industry is also very large. And although litigation finance investments do not have a negative correlation to traditional asset classes like life settlements do, they still only have a very low correlation to traditional asset classes. Prime Meridian currently invests in the litigation finance asset through two partners. Instead of buying individual lawsuit cases outright, we have structured our investments through a loan structure where we receive a high interest rate in the double digits. We currently have exposure to over 6,000 different lawsuits with an average case exposure of only $3,000 and an average collection time of 3 years. Prime Meridian prefers to invest in litigation finance through a loan structure because it provides both a good return and allows us to offer better liquidity terms to our clients, which they prefer. The third investment allocation type in the Special Opportunities Fund is specialty credit. Specialty credit involves making investments in the traditional consumer, real estate, and small business origination platforms that we have been making since our founding 8 years ago. The main difference between the investments in the Special Opportunities Fund that we typically provide capital in the form of lines of credit or something similar to the origination platforms to underwrite the loans in exchange for a predetermined interest rate versus buying the individual loans from the platforms like we mainly do in the other funds. The exact structure and type of the investment varies a little between each of these investments. Like I just mentioned, though, the structures are mainly credit facilities, but they could also be note structures or other loan structures which offer secured revolving facilities, secured pref, or mezzanine financing to the platforms. We are also very diligent to ensure the legal structures and the right covenants are included in the legal agreements when we invest in these deals for the benefit and protection of the fund. We currently have 5 of these investments, and the targeted returns for these deals are all in the double digits. Whereas life settlements and litigation finance have little to no correlation to traditional asset classes, specialty credit is definitely more correlated to the overall economy for reasons I explained in the current outlook section earlier. This being said, the specialty credit sleeve of the fund has still performed well this year, contributing overall positive returns to the fund. The current allocation of the Special Opportunities Fund across the three investment types is about 44% to life settlements, 25% to litigation finance, and 32% to specialty credit. The fund has returned just under 7% for the first 8 months of the year and just under 10% since inception on an annualized basis. A couple of things to highlight on the fact sheet is that there have been no negative months in the fund thus far since inception. Also, in January, February, and April of this year, we had at least one life settlement maturity, which boosted the returns to over 100 basis points for each of those months. And in the difficult month of March again, the fund still returned over 0.5%. The management fee is 1% and the performance fee is 20%. The fund has a 1-year soft lock and quarterly redemptions thereafter. So to summarize, we believe the Special Opportunities Fund is a very unique fund in that it offers investors a differentiated product that combines life settlements, litigation finance, and specialty credit all within one fund. The combination of these three verticals results in lower volatility and lower correlation to traditional asset classes, while historically achieving close to double-digit returns and still providing good liquidity. This fund has performed relatively well in both good and bad economic environments. In last year's good economic environment, it returned over 9%, almost 10% actually. And in this year's poor economic environment, it will still likely return again over 9%. And it looks like, Serena, we got another question. You want to ask that?
Yep. Do you think going forward that the current percentage across the three investment allocations will remain the same, or will it change?
Yeah, I think this year we have overweighted life settlements a little, which has benefited our investors well, but as the economy continues to slowly improve, we will most likely reduce the overweighting to life settlements and have a more equal weighting across all three allocation types. That was a good question. Thank you. The fourth main fund we manage is the Alpha-Centric Prime Meridian Income Fund, which is a mutual fund that we started at the beginning of this year. The investment objective of this fund is current income, uses no leverage, and has targeted returns between 6 to 8% a year. We started this fund because our other three funds are limited partnership structures that are only open to accredited investors. Over the years, though, we have received numerous requests to offer a fund to non-accredited investors so they could get quality exposure to alternative credit as well. We decided to partner with Alpha-Centric, which is a leading financial services firm that was started in 2014 to offer RRAs and their clients distinctive and innovative and best-in-class strategies that are typically only available to institutional investors in an open-ended mutual fund format. And the ticker symbol for the fund is PMIFX, Paul, Mary, Ida, Frank, X-ray, for anyone that wants to look it up. This fund invests in whole and fractional loans from the same origination platforms we invest in with the other hedge funds. The verticals available to invest in within the PMIFX fund are consumer loans, real estate loans, and small business loans. The fund currently only has investments in consumer loans and real estate loans across 4 of the leading origination platforms in these verticals. On the real estate side, it currently invests in about half single-family residential and half multifamily residential. Similar to the hedge funds, we use our own proprietary credit model for active loan selection to acquire these loans. The fund has performed very well year to date with a return net of all fees around 6%. There are 3 other alternative credit mutual funds similar to ours. We all use the same valuation methodology, and I believe we all actually use the same valuation agent as well for our funds. So it is an apples-to-apples comparison, and the year-to-date returns of the other funds are up around 3%, up around 1%, and even one that has a negative 11% net of all fees. So we're pretty proud of the performance we have of our mutual fund year-to-date. The minimum investment in our fund is only $2,500, which is much lower than our hedge funds, which have minimums of $500,000 each. The fund also offers quarterly liquidity with certain limits. We believe this is a great fund for non-accredited investors who want to invest in short duration, high-yielding alternative credit strategies as well that are not able to invest in the hedge funds. This is a multi-vertical alternative lending mutual fund, since it could also invest across the 3 different verticals. It is also a very good fit for accredited investors who maybe want to invest in the asset class but not want to invest at least $500,000, which are the hedge fund's minimum requirements for investment. As you might be able to see on the fact sheet, that you could go to alphacentricfunds.com to get more information on the fund to invest. And I see another question just came in. Serena, you want to ask that?
Yes. From an attendee, you stated the fund can invest across 3 verticals, including consumer, real estate, and small business, but currently only invests in consumer and real estate loans. Why is this, and how do you expect it to change?
Yeah, as I described earlier in the Outlook section, the small business lending vertical is quite challenged right now, and we are seeing better investment opportunities, frankly, in the consumer and real estate verticals. However, we will certainly consider adding small business loans to the portfolio if we find the quality small business loans that pass our credit model for purchasing. So thank you to whoever asked that question. All of our funds are set up for both U.S. investors and non-U.S. investors, and we are very balanced between the two. We have many investors in Europe, Asia, the Middle East, and Latin America, and travel frequently to meet with our clients here in the U.S. and around the world. Our operations team is very familiar with working with investors and their custodial banks in processing the needed paperwork. They are also very experienced in following all the regulatory requirements for global investors making investments into our funds. All of our hedge funds are structured as onshore master feeder, and each one has an offshore feeder fund into the master. For U.S. investors, we have our funds available on all the major U.S. platforms such as Schwab, Fidelity, and Pershing. For international investors, we are approved with several custodial banks such as Credit Suisse, HSBC, and Euroclear, to name a few. I have included the CUSIP, ISIN, and Bloomberg codes for each of the funds on this slide for easy reference as well. So to wrap it up, before we open it up for some questions, Prime Meridian offers 4 main short duration high yield alternative credit funds to investors. Even though each of the funds are a little different in terms of the verticals they invest in, all of them offer investors the ability to invest in alternative credit targeting mid to high single-digit returns, and in the case of the Special Opportunities Fund, possibly double-digit returns. The funds are typically lower volatility and less correlated to traditional asset classes. We were one of the first dedicated managers to this asset class when we started in 2012, one of the largest dedicated managers in the space today, and the only manager to have won an award for the top manager by the leading industry organization in our asset class. For those of you who are interested in receiving more information about us and our funds, please feel free to reach out to me directly, as my contact information, as you can see, is on the slide right now. And obviously feel free to reach out to Michael at Flya, and he can certainly move forward on any inquiries to me as well. And I think we have time just for a few questions. I see some here on the screen, so just in the interest of time, I'll go ahead and identify a couple and answer them. The first one is, are there any new alternative credit verticals that you might add to your funds, or any that you have stayed away from? That's definitely a good question. We are consistently identifying potential new verticals or platforms to invest in. Frankly, we turn the vast majority of these opportunities down for a variety of reasons, including not passing our extensive risk management process that I described earlier. We most likely won't be adding any new verticals per se in the foreseeable future, but we do look at additional ways to invest and add value within the existing verticals. And an example would be in the consumer credit vertical, there are interesting opportunities such as point of sale platforms or purchasing charged off consumer receivables. To the other part of the question, areas that we have never really been interested in, I would say that would be student loans, because their yields are usually too low to be a fit for us. Maybe a couple more questions before we wrap up. You mentioned earlier the importance of manager experience in this asset class. Could you please elaborate a little further as to why so many managers have closed? That's definitely a relevant question, and happy to add some color. There have been some very smart academics and business people who have started funds in this asset class, but they didn't have any proven previous money management experience in generating alpha or managing risk. And many of them started to use leverage or use lines of credit and lower the credit quality to chase more yield. As soon as there was a hiccup in performance, taking on additional risk in the portfolio blew them up, just to state it bluntly. Or many of the managers didn't properly implement the right infrastructure to provide investors peace of mind on the safety and soundness of their assets. Many, for example, didn't use custodians or even use a third-party valuation firm, which resulted in many investors not confident to allocate capital to these types of managers. So the managers either blew up or they had to shut down because they couldn't raise capital. Next question, is Prime Meridian planning on launching another fund soon? We currently do not have any plans on launching another fund. We are focused on the 4 main funds we manage now. We are certainly open to it and try to be as flexible as possible in starting new products that meet our clients' needs, which has led us to starting the different funds we already have. It looks like we have just a minute left or so, so I'll wrap it up with this final question before I turn it back over to you, Michael. What are some of the negatives of investing in alternative credit? That's a good question. There's always positives and negatives to any investment. I think the biggest item or two in the alternative credit asset class that are potential negatives is that these are level 3 assets, which means that they're not nearly as liquid as other traditional asset classes. That is why most investors invest only a percentage of the portfolios in this strategy and have other more liquid investments, usually across more traditional asset classes, to tap into quickly if needed. And the other one I think would be is that the income on the loans is considered interest income and taxable at someone's personal income tax rate. And so what most investors do is try to invest through non-taxable or tax-free accounts such as IRA accounts, Roth, or regular accounts. And then every non-US investor obviously comes into the offshore feeder to invest in the fund. So that puts us kind of right at 11 o'clock, Michael. So I'll turn it back over to you, and really appreciate everyone's time today, and look forward to speaking to you further for those of you that are interested and maybe have some follow-up questions. Michael?
Thank you, Jeremy. Thank you, everyone, for participating today. We hope you enjoyed the presentation on alternative credit and Prime Meridian Capital Management. Jeremy did an excellent job. Thank you, Serena, for assisting. Currently, Prime Meridian is accepting additional investments in its open funds. Please feel free to reach out to Jeremy Todd directly if you're interested in learning more about Prime Meridian, or to me directly, and I'll forward on any inquiries. We will also be sending out a recap of this presentation here today. So give us a couple of days to get that over to you. Inside of the email, you'll find all the information to reach out to Jeremy directly again. But thanks again to the Prime Meridian Capital Management team, and thank you all for participating. Have a great day. Bye now.